Welcome to V Invest, the channel dedicated to sharing insights on the mindset and art of trading. Trading is a challenging journey, not just because of market volatility, but also because of the mental traps lurking deep within every trader's mind. Now, we'll dive deep into the 4 key psychological factors that influence trading: greed, fear, overconfidence, and FOMO, with specific scenarios to illustrate them and historical trading stories to clarify the lessons. Greed, the silent enemy of every trader. Greed is one of the most powerful human drives. But in trading, it's often a path to disaster. When greed takes over, you stop trading based on logic or a plan and get swept up in dreams of massive profits. You bet more than you can afford, refuse to take profits because you think prices will climb higher, or trade excessively to maximize opportunities. Imagine you're Michael, a Forex trader with a $5,000 account. You spot EUR/USD in a strong uptrend. After entering a buy order at 1.1800 and watching the price rise to 1.1850, you earn 50 pips of profit, equivalent to $250. It's a great day, exceeding your 1% goal of $50. But instead of locking in your gains, you think, the price is still rising, I can make another 50 pips. You hold the position, even doubling your size. Suddenly, an unexpected economic news release sends the price tumbling to 1.1750. Not only do you lose all your profits, but you're also down $500, 10% of your account, just because you didn't know when to stop. Greed doesn't just show up when you're winning. When you're losing, it can push you to overtrade to recover losses, acting like a gambler in a casino, betting bigger and bigger to offset what's gone. Historical story: Jesse Livermore and the 1929 crash. Jesse Livermore, one of the legendary traders of the 20th century, is a vivid example of greed's destructive power. Throughout his career, he made millions with his uncanny ability to read the market. Before the Great Depression of 1929, Livermore correctly predicted the stock market would crash and shorted stocks. As the market plummeted, he pocketed over $100 million, a staggering sum back then. But greed wouldn't let him stop. After that resounding victory, Livermore kept trading on an even larger scale, convinced he could repeat his success. He ignored risk management rules, and within a few years, lost nearly everything due to greed-driven decisions. In the end, Livermore went bankrupt and died in poverty in 1940. Lesson: greed can lead to big short-term wins, but if left unchecked, it will destroy all your achievements. Livermore once said, "The market is never wrong. Only human greed is." To overcome greed, we need to set specific profit targets before each trade and stick to them religiously. If you aim for 1% profit daily, take your gains when you hit that mark, no matter how tempting the market looks. Use a clear trading plan to separate emotions from actions. Write down your entry, profit target, and stop loss before you trade. Look beyond a single trade. Remember, trading success comes from long-term consistency, not from trying to conquer the world in one move. Fear, the shield that blocks success. Fear is a natural instinct that helps humans survive. But in trading, it's often the biggest barrier keeping you from reaching your true potential. When fear takes hold, you hesitate before good opportunities. Close trades too early because you're worried the market will reverse, or even stop trading altogether after a few losses. Picture yourself as Emily, a new stock trader. You spend hours analyzing stock ABC and notice it's hitting a key support level at $50. With a spike in trading volume, a sign of a potential rally, you plan to buy in and wait for the price to reach $55 to take profit. But when the price dips slightly to $49.50 right after you enter, fear kicks in. You think, what if it keeps dropping? I don't want to lose more money. Emily quickly sells at $49.80, taking a small loss. Then, the price surges to $56. Just as you predicted, if fear hadn't taken over, Emily could have made a 10% profit in just a few days. Fear doesn't only affect beginners. Even seasoned traders can be paralyzed by it during sharp market swings or after a string of losses. It makes you doubt your trading system, even if it's proven itself. Historical story: Nicholas Darvas and the lesson of fear. Nicholas Darvas, a dancer turned trader in the 1950s, turned $36,000 into over $2 million with his unique box theory strategy. But early in his career, Darvas was heavily swayed by fear. When he started, he often closed trades too soon. afraid of losing the small profits he'd made. In one trade with Lorillard stock, Darvas bought in and earned a 10% gain in just days. But when the price wobbled slightly, he panicked and sold immediately. Even though the uptrend continued, he later realized he'd missed out on doubling his profit, simply because he didn't trust his own analysis. Darvas wrote in his book, How I Made 2.000.000 in the Stock Market. Fear cost me thousands of dollars before I learned to control it. Lesson: fear can shield you from risk, but if you don't manage it, you'll miss out on big opportunities. Darvas overcame fear by building confidence in his system and accepting losses as part of the game. To conquer fear, we need to accept losses as a natural part of trading. Treat each losing trade as tuition for improving your skills. Keep a trading journal to boost your confidence. When you see your system has a consistent win rate over time, fear will fade. Focus on the process, not the outcome. If you follow your plan and manage risk well, a few losses won't ruin you. Overconfidence, the trap after victory. Confidence is essential for success, but when it crosses the line, it becomes overconfidence, a dangerous trap that makes you ignore rules and underestimate risk. After a winning streak, you might think you're invincible, ramping up trade sizes, skipping stop losses, or acting without careful analysis. Imagine you're David, a crypto trader. In 1 week, you trade Bitcoin and win 5 trades in a row, turning $1.000 into $1.800. The thrill makes you think, I've got the market's rhythm nailed. In your next trade, you see Bitcoin climb from $50.000 to $52.000 and decide to buy in with all your funds. No stop loss, because you're sure it'll hit $55. But a sudden government announcement sends the price crashing to $48. In minutes, your account plummets from $1.800 to under $200. Overconfidence wiped out your gains, just because you ditched discipline. Overconfidence doesn't only come from wins. Sometimes, it creeps in when you learn a new strategy and assume you've mastered it without enough practice. Historical story: Paul Tudor Jones and the 1987 mistake. Paul Tudor Jones, one of the greatest hedge fund managers, famously predicted the Black Monday crash of 1987, when the U.S. stock market collapsed. Before that, he'd made huge profits shorting the Dow Jones Index, but he later admitted to a period of overconfidence after that win. In a later trade, Jones bet big on the commodities market without setting a stop loss. Convinced he could repeat his perfect calls, the result was a heavy loss when prices moved against him. Jones later said, "Confidence is good, but overconfidence is a silent killer in trading." Lesson: consecutive wins don't make you unbeatable. The market always finds a way to remind you no one controls it fully. To manage overconfidence, we need to always set stop losses on every trade, no matter how confident you feel. It's your shield against unexpected swings. Regularly review your strategy and results. Even when you're winning big, markets evolve, and you must adapt. Stay humble. Treat each trade as a fresh test, not proof of your genius. FOMO, fear of missing out. FOMO is the urge to act when you see others making money or the market moving fast. It drives you to jump into trades without proper analysis. Buy at sky-high prices because you fear the train's already leaving. Or follow the crowd without a solid plan. Picture yourself as Alex, an individual investor in the U.S. stock market. When XYZ stock shoots from $20 to $30 in 3 days. Social media buzzes with talk of a golden opportunity. Alex doesn't want to miss out, even though he hasn't researched the company. He buys in at $29.50 with his full $50.000 capital, thinking it'll hit $40 soon. But after peaking at $31, XYZ drops to $25 as big investors cash out. Alex loses 20% of his capital, just because FOMO swept him away. FOMO doesn't only strike when markets rise. In a downtrend, it can push you to panic sell at the bottom because everyone else is freaking out. Historical story: the tulip mania of the 17th century. One of the classic examples of FOMO is the tulip mania in Holland during the 17th century. Considered the first financial bubble in history, rare tulip bulb prices soared from a few guilders to hundreds in just months, sparking a frenzy as people rushed to buy, fearing they'd miss a chance to get rich. Many borrowed money or sold homes to invest, believing prices would climb forever. But in 1637, the bubble burst, tulip prices crashed, and thousands went bankrupt. FOMO turned a flower market into a financial disaster. Lesson: the crowd isn't always right. Trading on FOMO is the fastest way to lose money. To avoid being swayed by FOMO, we need to make a clear trading plan before entering a trade. If you don't have time to analyze, stand aside and wait for the next chance. Focus on your own strategy, not the crowd's frenzy. Markets always offer new waves. Check your motives. Are you trading based on logic or external pressure? If it's pressure, stop. Want to dig deeper into trading psychology? Sharpen your trading mindset and learn what it takes to become a pro trader. Hit that like button to support V-Invest. Subscribe to the channel now and ring the bell so you never miss our latest videos. Catch you in the next one.